You wake up one morning. Nothing looks different. No trucks delivered cash overnight. No printers ran in the basement of the central bank. And yet, there is more money in the economy than yesterday. Not metaphorically, literally. That's not a conspiracy. That's the system. Most people believe money is created when governments print it. Bills, coins, minted and controlled. But physical cash is a tiny fraction of modern money, less than 10% in most countries. The rest is created somewhere far less visible, inside banks, quietly, with a few keystrokes. And that matters more right now than almost any other economic fact, because inflation, debt, housing prices, financial bubbles, even economic crashes, they all start here. Let's slow this down and strip it to its bones. Imagine you walk into a bank and ask for a loan, not for something exotic, just a regular loan. A home, a business, a car. The bank does not walk to a vault and check if your money is sitting there. That's the first uncomfortable truth. Instead, the bank looks at you, your income, your credit history, your likelihood of paying it back. If the bank says yes, something strange happens. They don't hand you existing money. They create new money. Right then, on the spot, your loan is approved and your account balance increases. That number did not come from another depositor. It wasn't transferred from savings. It wasn't printed. It was typed into existence. At the same moment, the bank records something else, an asset, your promise to repay. From the bank's perspective, this is balanced. They created a deposit, which is a liability, and a loan, which is an asset. On paper, everything matches. In the real economy, money just appeared. This is not a loophole. This is how modern banking is designed to work for decades. Most people never hear this explained clearly because it sounds absurd and slightly terrifying. If banks can create money, why can't they create infinite money? This is where the constraints come in. Banks are limited, but not by cash. They are limited by regulation, capital requirements, and risk. They need enough capital to absorb losses. They need to meet regulatory ratios, and they need borrowers who look safe enough. Notice what's missing from that list: deposits. Deposits do not fund loans in the way most people imagine. They follow loans. They don't lead them. This flips the story most of us were taught. Banks are not intermediaries, passively moving money from savers to borrowers. They are money creators, actively expanding the supply when they lend. This is why credit booms matter so much. When banks feel confident, lending expands. More loans, more deposits, more money. Asset prices rise. Houses get more expensive. Stocks climb. The economy feels strong. Then confidence cracks. Defaults rise. Risk looks scarier. Banks pull back. Loan creation slows, or stops, or reverses. And when loans are paid back or written off, money disappears. Literally. Repaying a loan destroys money. The deposit shrinks. The asset is reduced. The money supply contracts. This is why financial systems feel unstable, because they are built on expansion and contraction of credit, not printing. Now let's address the obvious question. Where do central banks fit into this? Central banks do not create most money directly. They influence the conditions under which banks create it. Interest rates, liquidity facilities, regulation. When a central bank lowers rates, borrowing becomes cheaper. Banks are more willing to lend. Money creation accelerates. When rates rise, lending slows. Money creation tightens. This is why interest rate changes ripple through everything: mortgages, businesses, governments. But here's the irony. Central banks are often blamed for printing too much money. In reality, they are reacting to a system where private banks already control the accelerator. The uncomfortable math is this: most money in the economy exists because someone is in debt. Your deposit is someone else's loan. Money and debt are inseparable in modern finance, two sides of the same balance sheet. This is why debt keeps growing, even when people are paying it back, because new loans are constantly replacing old ones, often larger, often riskier. And this is why crises are so hard to stop. When confidence collapses, money creation doesn't just slow, it reverses. Credit shrinks, assets fall. Defaults rise, banks become defensive. The system designed to expand suddenly contracts, and governments step in, not to print money out of nowhere, but but to prevent total collapse of credit. This is also why inequality shows up here. Those closest to new money creation benefit first: asset owners, borrowers with access, institutions. By the time money filters through wages and prices, the value has already shifted. The system isn't evil, but it isn't neutral either. It rewards access, timing, and confidence. So when people ask, why does money feel fake now? Or why does everything feel more fragile? Or why does debt never seem to shrink? This is the answer. Money today is not a thing, it's a process driven by banks creating and destroying money through loans, quietly, continuously. No printers, no trucks, no vaults, just balance sheets. And that leaves us with a final question. If most money exists only because banks believe borrowers will repay, what happens when belief runs out? Because in a system built on confidence, the scariest moment is not when money is created, it's when it stops.